Hello and welcome to the Hawaii Housing Report. I'm Patrick ONeill, owner of Luxury Homes International, and with me today, as always, principal at TZ Economics and Hawaii's undisputed favorite economist, Mr. Paul Brewbaker. Paul, aloha Friday.
How's it?
Hey,
happy
good.
happy 3-day Juneteenth weekend.
Yep, fantastic. So, okay, well, we've got a lot to talk about. We have the latest housing statistics. I think there's good and bad news in there for both buyers and sellers. We'll cover that in a moment. But we really need to talk about the Fed and their actions this week.
Mhm.
After 10 consecutive raises going back to March of 2022, the Fed has left their key rate unchanged.
Mhm.
Um, some interesting comments were made and some interesting data was released. What was your take and what have you learned?
Well, first, it is having not changed the target Fed funds overnight interbank lending rate. The Fed actually, it means the Fed stopped raising the Fed target last month, right? They didn't move this month. So when history is written, they stopped raising rates in May, and they're standing pat now. Obviously, their decisions will continue to be data dependent. They use that expression in the communication in the what do they call? We were just talking about it, but informally, open mouth operations, unlike open market operations, or forward guidance. That's the phrase I'm trying to think of. And they use these expressions very carefully, and they come back to them. They talk about inflation expectations being well anchored. They, as I say, use forward guidance, explicit communication of their own objectives, their own expectations, their own numerical forecasts in order to align expectations of market participants with their own. And so everybody's on the same page. We can all see the data evolve together. But for now, they're done raising rates. They think they've done enough. Inflation has been falling. If it continues to fall and carries through, it will have validated their decision last month to end the rate increases, or this month to make it clear that they're not intending to raise rates. And Jay Powell actually said, if I recall correctly, that he wouldn't expect any rate increases for the next 6 months. I thought that was an extraordinary revelatory
Hmm.
moment. Usually he won't make anything,
Uh,
he won't
the
go
way
that
that
far out on a limb.
what I heard from him is don't expect any rate cuts this year. But
There's that.
there
Yes.
is the possibility of a rate hike in July. And I don't know if that was just to tell the markets, don't get too happy that we're not cutting. Don't start to ramp back up. What do you take
So,
on that?
well, they used to actually debate language that talked about the balance of risks in their statements, over the last 10 or 20 years. Are the balance of are risks sort of balanced to the positive or negative side, for example? So what you just described suggests at the margin, they're more concerned about the possibility that inflation might not come down as fast as they'd like. And so they're, keep keep the door open for a rate increase with a higher probability of that happening than a rate decrease,
Right. And
given that
they
inflation, yeah,
and the Fed is looking at the core rate, not so much the headline rate. If I
that's right.
understood correctly, Chairman Powell said right now the core rate is about 4.5%. They expect that to be somewhere around 3.9 by the end of the year.
Yes, and to continue declining thereafter. The core rate, for everybody that doesn't always remember the details, is the rate of inflation without food and energy costs. In the personal consumption expenditure deflator, the core rate has a housing weighting of about one half. Housing is about the housing components of the core PCE are about half of the index. In the consumer price index, which tends to be a little higher measure of inflation than the PCE, it's about a third, not quite 40% of the composition of the elements that together, the various contributors that make up the measure of inflation, for
Mhm.
which we have a Hawaii counterpart. We have an urban Hawaii consumer price index, but we don't have a PCE deflator for Hawaii. Uh, that it's for a variety of structural the construction of the indices themselves lead them to tend to favor the PCE deflator, the core inflation measure.
And I did note in Chairman Powell's speech that he said, I expect housing prices to remain flat through this year, both on the rental side and on the sales side. Does that kind of track with what you're looking at, what you see?
Well, of course, location, right? Your neighborhood, your mileage may vary, and but yes, monetary policy is conducted with respect to the national economic landscape or inflationscape, as it were. For example, let me just show you the Hawaii data have consistently over the course of this 2-year now inflation impulse, right, rising for about a year and now falling for about a year. Hawaii inflation consistently has been below the national average. It's an average. That means there are states and regions which have higher inflation than the national average. And Hawaii's inflation has already come back to the 2% goal, even below it, because the Fed's goal of 2% correspond for the PCE deflator corresponds to about 2.5%, maybe 2.4%, where that horizontal bluish line I've drawn indicates we've now slipped just under here in Hawaii. But yes, US inflation up around 4%, measured by the CPI. The core PCE, a little more resistant, sticking to getting stuck somewhat, coming down less actively, so to speak, not responding as much to some of these other, there's a drop in the price of oil and some, well, of course, we take out the price of oil in the core rate. So, their goal is to get inflation down. That's priority number one. It's sticking, it's a little sticky on the way down. And so their tendency will be lean in the direction of raising rates if they need to, rather than lowering rates.
All right. And ultimately, we're concerned about this because of the effect on the interest rates. So why don't we bring in Anders Hostelli from Guaranteed Rate Mortgage here in Hawaii. Anders, are you there? There he is. All right.
Yeah.
All right. So Anders, what was your take on the Fed's comments and their decision to leave the rate unchanged?
I mean, they I think as anticipated, they paused, right? So, the market, it's interesting, right? What you look at were mortgage rates, they actually didn't react well. Kind of surprisingly, rates moved up on Wednesday after the announcement came out, and then yesterday they kind of came back down a little bit. So I think the mortgage market, and we're just kind of looking at how mortgage or MBS trades is kind of digested the comments and kind of what they're projecting going forward. So when you look at last month, I know we talked about mortgage rates, and we're pulling up the Freddie Mac here, mortgage market survey. Rates were kind of hitting 7. I know you said 7. I'm like, yep, 7. But at least they've come down a little bit. So it's a little bit below 7, kind of in the high 6s right now, which is still, when you look at the last few years, it's definitely on the high side, but it's still, not too bad, I guess, when you're looking at mortgage rates.
Yeah. So last week you and I were talking, and this was before the announcement. Rates were consistently over 7, right? They were they're hovering right above. The announcement came out, there was really no change, but then you're saying now the bond markets have sort of reacted a little bit, and now we're down. This Freddie Mac is showing a 6.69 on the 30-year fixed. Is that close to what you're actually underwriting loans for?
Yeah, that for an owner occupant with like 25% down, I priced it out in our system, and yeah, it's kind of right in that high 6 range, depending on the credit score, of course.
I got you.
So, yeah, this is pretty consistent.
Yeah, and it's been tough, I know, on the buyers figuring out when to loan lock. When it was in the high 6s a couple of weeks ago, everybody, I should say everybody, sort of seemed like we should wait, let it come down, and then the rates went back up. So I guess maybe it's a little good news that it's back down to
my advice on locking, you always you want to look at your payment that you got to pay, make sure that that's comfortable, and focus on that. And to me, it's always better to just be safe and just lock in, because you just don't want rates to jump and just really impact your mortgage payment that you're looking at.
I got you. And Anders, we had talked about this earlier. There's always been a little spread between a vanilla single-family home purchase and a condo purchase
Mhm,
at
mhm,
the 20% down.
mhm.
If we're at 6.69 right now for a single-family home, what's the spread there if someone is purchasing a condo?
So somebody, so whenever someone is looking at, and this is for Fannie Mae and Freddie Mac loans, there's a loan level pricing adjuster if it's a condominium, if your down payment is less than 25% down. So let's say somebody's putting 20% down. So compared to a single family home, then their rate is going to be about an eighth higher in interest rate on a condo.
Yes, but if they put 25% or more, then they're going to be at that same rate.
That is correct. Yes.
Okay. All
Yeah.
right. And I know one of the things that you track on a weekly basis are the loan originations, the
Mhm.
loan locks. What are you seeing? Any change at all? Still minimal
It's
activity?
pretty kind of steady as she goes. It really, I know, first we're always hoping for there was going to be a spring uptick, and but yeah, I think there's still a issue with lack of really good inventory in homes, like
Hmm.
good homes to people want. There's still a lot of buyers out there. There really are. We're doing a
Right.
lot of pre-approval still. People are interested in purchasing even where mortgage rates are, but the availability of homes has been a big challenge.
Okay. And we had talked last week about some of the regional banks seem to be pulling back on some of the mortgage products or potentially increasing the requirements. Are you seeing that across the board, a little bit?
I mean, across the country or even locally here, we've seen some adjustments. Maybe some of the adjustable rate loans, the rates are getting a little bit higher, or the spread between the adjustable rate and the fixed rate isn't as large
Mm,
as it was. But when you're looking at mortgage rates, they're just kind of following what the market's doing.
I gotcha. I understand. Okay. And then last month, I had asked you for a couple predictions. I just want to remind you, you had picked the Boston Celtics over the Miami Heat. That was incorrect. And but you were correct on the Denver Nuggets. So that was
Okay. Okay.
congratulations. All right. And you had also said then, I'm just curious if you still think that rates will fall to 5.5% by December of this year.
I still think there's a good chance of that. Yeah, I do.
Okay.
Yeah.
Okay. Well, that's great to hear. All right,
And
and Anders,
you'll remind me, right? Okay.
I'll remind you, that's right. It's all
Yeah,
recorded, so
yeah,
we'll
yeah, yeah. It's
we'll
just
go
my
back and
opinion,
check.
right? It's just okay.
That's right. That's
Yeah,
right. Anders, really, really appreciate you
appreciate
coming
it.
on
Thanks.
and sharing the knowledge. It's really great to hear. So really appreciate that.
Appreciate it.
Everybody stand by. We're going to be right back with Hawaii's favorite economist, Mr. Paul Brewbaker, after a short break. Okay, and we're back with the Hawaii Housing Report with economist Paul Brewbaker. Paul, what did you think about Anders' comments? And do you have anything else you want to add about inflation or the Fed's actions?
Well, there's the for the same reason that inflation in the core rate has been sticky. The data I showed you were the so-called headline rate that include food and energy costs, where food can be planted and grown relatively quickly, and oil can be pumped out of the ground when prices get excessively high. So in both of those cases, we've seen the supply response, say, since the invasion of Ukraine in February 2022. More food's been produced, more oil is coming out of the ground, so to speak. And as a consequence, those prices have come down. And therefore, the inflation that includes those prices has come down. The inflation that excludes those prices, the core rate, is the sticky part. And because it's sticky, it means it raises the risk that maybe the Fed isn't achieving all it wants to in terms of reducing the core rate. And part of the reason those mortgage rates have been sticky as well is because not achieving what the Fed is seeking to achieve raises uncertainty about whether they're going to be able to at all, right? You see what I mean?
Yeah, of
So
course.
that uncertainty shows up in the markets in a very specific way. Here I've got an image showing the mortgage rate that Anders was talking about, the upper blue line here is the Freddie Mac weekly average mortgage rate. Actually, these are monthly averages, I believe. And then on the lower black line, the so-called risk-free rate, the yield on the 10-year U.S. Treasury bond. So presumably, U.S. Treasuries are a no-risk loan to the government, so to speak, and mortgages have a little bit of risk. And you can look at by how much the spread, the difference between mortgage rates and Treasury yields moves around over time as an indication of uncertainty or risk. So let me contrast two very similar periods. This yellow bar here in 1994, when the Fed began raising rates, was concerned about inflation, began raising interest rates for the first time since 1989, for the first time in 5 years. In those days, without an announcement, no press conference from Alan Greenspan, no statement of what the Fed decision was, not to mention no forecast from the Fed. But at that time, you can see both mortgage rates and Treasury or long-term Treasury yields went up at the same rate and left the difference between them, this blue area at the bottom, largely unchanged. Now, the average from 1992 to 2019, the average spread between mortgages and Treasury yields is about 170 basis points, 1.7%. So if you had a 3.5% mortgage rate, 3.5% Treasury yield, you would have a 5.2% mortgage rate. What's the yield on the 10-year Treasury note today? 3.7. So ordinarily, you'd expect 3.7 plus 1.7. You'd expect already to have a 5.4% mortgage rate, as Anders suggested we might get to by the end of this year. But we'll only get to that if this difference, which is ordinarily 1.7 percentage points, but today is 3 percentage points.
And as I look at the differential, the blue
if that comes down,
you can see it clearly comes up when there's some sort of trauma or shock to the market.
Exactly.
You got the .com, you got financial crisis, you have COVID, now you have whatever you want to call
whatever is going on right now. And
so
what's going on? Well, it's a regional banking turmoil. Right. It's uncertainty about whether the Fed's inflation agenda is actually going to be achieved. So now the Fed tells us where we're going, and I'll show you that slide since we're, what happened? Whoa, okay, let's get out of here. The Fed does let us know, what they believe is the likely path of interest rates. And at the time of the press conference earlier this week, they posted those results for the next couple years. So here's the picture. Again, we're looking at Treasury yields, a whole spaghetti of them. I've got every Treasury bond from the 3-month Treasury bill all the way out to the 30-year Treasury bond. And then in this heavy black line at the towards the top, the 10-year note yield. And you can see those interest rates are all clustered between about 3.5% and maybe 4.5% right now, okay? And the Fed's overnight rate, which has gone up to a range of 5 to 5.25%, so the sort of upper and lower bound, that the Fed in its own forecast expects it to stay there for the remainder of this year, expects that it will be able to ease that rate back down to a neutral rate of 2.5% by 2026, by the end of 2026. That's an extraordinary amount of guidance from the people actually in charge of determining this rate. And you can see that there is disagreement among the various members of the committee that provide the forecast. Some think that rates will have to stay high, actually go higher and stay high for a long time. Some think that they'll be able to bust a move very quickly as we move out of this year into next year. But as I say, that's, it's unlikely that the Fed's going to have to deviate far from that path that they laid out. Rates where they are now, rates falling next year, beginning to fall next year, unless some real surprise happens. And of course, surprises happen, which we see in that risk spread.
That's right. Yeah. Yeah. And it's interesting. I think that's what everybody would say that they feel on the street is just this uncertainty and therefore the risk premium. Paul, let's jump over into the housing statistics then. We'll take a look and let me pull this up. This is the latest data from the Honolulu Board of Realtors. And this is for the month of May. So I thought we'd start with closed sales. This is the year-over-year number, down substantially, but this is the real number I wanted to focus on. This is the year-to-date. Single-family homes, let's call it, they're down 36%. We're in June right now. The biggest drop in closed sales historically in Honolulu was after the Japanese bubble period in 1991. You can see in 2008, it dropped 24%. Last year, we already saw a 23% drop. Do you suspect that this will continue through the rest of the year? It kind of feels like that.
Honestly, I think that the sales, okay, so you have to be careful here. The 35 or 40% decrease from last year to this year says something about this year as well as last year. Were sales falling at this time last year? Yes.
Yeah, they were starting to.
They were starting to fall, right? So at some point, you see what I mean? At some point,
this number is going to become smaller on a monthly basis, and we'll see where we end the year. Okay, that makes sense.
I think we may be. I actually think we're off the bottom, so to speak. We can look at that in a slide in a second.
Active inventory, not a big surprise. It is up. These numbers are not as dramatic as they've been earlier in the year, but we're still up 15% on single family homes. There's nearly 20% more condos on the market today. New listings, and then we've talked about this before, new listings for single family homes compared to last year is down 30%. No one's going to sell their home when they have a 3% interest rate to go buy something right now at 7%, right? So it's just everything's frozen until the rates start to release, right?
Yes.
Yeah. Okay. And if we look at
the nerds will recognize that the duration of say mortgage assets has lengthened out. Everybody's just going to stay where they are.
Right. Well said. That's lengthened out. In the past, somebody would keep their property 7 to 8 years. They'd either sell or refinance. But now you're not going to leave that 3% or that 4%.
Well, reasons to leave do come up. I mean, you know,
right. Well, there's still movement, right?
At
but
some
in comparison,
point, that's right. It'll be a while before we get back to where those factors come to dominate.
Yes, and then this is a figure that takes active inventory against the absorption numbers, months of active inventory, and we talk about this all the time. But at 2.2 for a single family home, that's historically a strong seller's market, correct?
Historically a tight housing market, but it can be tight and not have any sellers, which is what we have now.
Right. So it's tight. And I'll point this out. As bad as things are right now, 45% of both single family homes and condos last month sold at or above full price. That just blows me away. But that's what's happening. You know, everybody.
I'll tell you what, I will surprise you even further when we look at some of these data in a time series form in just a second.
Yeah. And then finally, pending sales, not really that big a news, but this will be over 1 year of consecutive pending sales dropping. It's just telling us what's going to be coming to the forefront. Well, Paul, let's take a real quick break and we come back. Let's pull up your data and look at some of the long-term trend lines. And then we're also going to talk about pricing. So stand by. We'll be right back with economist Paul Brewbaker.
Great.
Hello, and we're back with economist Paul Brewbaker. I'm Patrick ONeill, owner of Luxury Homes International. And if you've enjoyed this information, please give Paul a thumbs up down below and subscribe to the channel so you don't miss next month's market report. So Paul, let's shoot back. We're just about to look at prices. Let me pull up the information here from the Honolulu Board of Realtors, and we're going to take a look at the median pricing year over year. I mean, I'd call it relatively flat, down 3.9 for homes, down 2.2 for condos. We look at the year-to-date numbers, single-family homes down 6%, condos down 2%. Just sort of seems meh, I guess you'd say, nothing, kind of flat. What's your take more on the longer term for pricing?
You've got this pattern, which we've talked about in the past, where price appreciation on Oahu, single family condominium prices was relatively steady, 4 or 5% per year, a little faster in the condo space, a little faster in the more affordable space from a lower low at the end of the 2008, 2009 recession. Then comes the pandemic, a disruption that leads because of remote work and the embrace of working from home, the residual embrace. A lot of people did it after the initial months of pandemic, but more people continue to work remotely today than was true pre-COVID, and that's looking like it's going to stick. So that tends to shift the demand away from the urban core, where more of the houses are single family. It tends to shift the demand towards a larger house so that you don't have to work from home around your kitchen island. And then, of course, the rate increases that the Fed began engineering in February 2022, causing sales to slip and prices to slip both in the single family and condominium segments. But here in these first 5 months of 2023, where I'm circling with the cursor arrow, on a seasonally adjusted basis, and caveat, my seasonal adjustment, not the Honolulu Board of Realtors. Mahalo and props to the Honolulu Board of Realtors for providing so much data for the public to use. You're doing a public service. And by the way, they've given me even more data, and I'll be rolling some of those analytics out at the regional Honolulu Board of Realtor events that are organized this summer, and capstone event that Patrick's organizing at the end of August. But to come back to this point, prices in the single family space have actually been rising this year on a seasonally adjusted basis, if you take into account that prices in April are lower than they tend to be the following summer, regardless of what's happening in the backdrop. And then in terms of sales volumes, which we were looking at a moment ago, let me also point to a parallel between the 94 Fed tightening and the current and now concluded, at least paused, Fed tightening, where I'm showing here sales volumes on Oahu in blue, seasonally adjusted again by me. And then the Fed funds rate, the target rate that the Fed uses as an instrument of monetary policy, as well as a signal of what its intentions are. In 1994, the Fed raised interest rates unexpectedly, caused a dramatic decline in housing sales volume, which then lingered at the bottom or near the bottom for a few years. Asian financial crisis occurs in this period as well, unraveling of the Japan bubble, etc. But around 1997, 1998, sales volumes began to grow. And in fact, both in the decade that followed and in the recently concluded decade, notwithstanding the COVID, the scary COVID moment, sales volumes, unless otherwise perturbed, have this tendency to rise over time for periods of as long as 8 or 10 years in the recent past. There's a possibility, now that we know that the Fed, which this time announced what it was doing, gives us forward guidance on where it's going, has reassured everybody that as long as inflation continues to subside, it probably won't raise interest rates from this upper bound of 5.25. It's possible we could settle in to a bottom for sales. We've already seen a deeper bottom and have rebounded into a sort of a low level equilibrium from which could emanate, in principle, over the next 5 or 10 years, a long ascent in sales volumes. Oh, let me point out one other thing. When those sales volumes grow, they can grow right through a recession like the 2001 recession, the dot-com recession, the 9/11 terror event, right? There can be a fair amount of resilience. And one can even make the argument that even in the face of COVID-19, where sales understandably dropped for much of 2020, the connection between what happened after that and before suggests a kind of resilience as opposed to a kind of vulnerability. Now, at a 6.5% or 7% mortgage rate, less of an appetite than at a 5.5% mortgage rate that Anders was suggesting is still possibly in the cards for as soon as the end of this year, or let's say next.
So what you're, if I'm hearing what you're saying, we're going to go through this period of, well, we're going through it right now, this correction period.
We're living it.
We're living it right now, the correction period, and that potentially, whether we have a soft landing or whatever it's going to be, bumpy landing, after that, we're kind of poised to go back on a long-term, now steady run up in the market. Am I hearing you correctly?
Yeah, I mean, remember why we're going through what we're going through. The post-pandemic environment was a highly disrupted one where supply, partly because factories are just shut down and people were, sent home. The supply side of the market could not respond as smoothly, as elastically, when the demand side of the market came back, when people got their stimulus checks, and even though they're not going out to eat, they decided to buy stuff on Amazon. So that early part of the inflation, which had a big supply component, was compounded by the demand side, by stimulus, people going back to work, people's confidence being restored. And those pressures unfolded over about a year, less than 18 months, and now they've been unwinding for at least a year, right? Hawaii's inflation rate peaked in March of last year. It's June. Hawaii inflation has been falling for 15 months and is already back to where it was pre-pandemic, has already achieved the Fed's objective in a world in which the Fed's objective has been achieved nationwide, which could be by the end of this year or almost certainly by sometime next year. Everything should fall back into place for steady she goes. And that kind of an environment, is, you suggested a second ago, is the one in which you'd expect home prices in a 2% inflation environment. You'd expect home prices to rise at 4%, maybe 5%, right? You'd expect a 2% real return per annum, 4 minus 2, a 2% real return, like the real return on capital, the real rate of productivity growth, and so on, to be consistent with economy-wide full employment performance.
And Paul, I want to point out why I'm such a fan of yours from the past. In the middle of the 90s, I know it was kind of by a joke, but you almost called the day that the market started to improve and go back up. And then I remember being at the regional meeting, realtor regional meeting during the subprime when things were on fire. You said, "Hey, everybody, get ready because it's not going to last." And everybody booed you at that meeting. And then in 2019, the last time we did our mid-year real estate review, which we're going to do in August, you said, "It's going to be steady as she goes unless there's a biological or political event." And I came up and asked you, what does biological event mean? Hello, COVID, right? I mean, I was like,
if there's a pandemic or if Russia invades Ukraine, I mean, I don't know.
Paul Brewbaker Patrick. It was amazing. Well, listen, Paul,
better to be lucky than smart. That's all.
You were smart and you called all these things. So I just want to, this from last month, you had said that home prices in December 2023, end of this year, would be about the same. Do you still feel that's where we're going to be?
Well, sorry, it's kind of, condos versus single family, but
single family homes.
Same as what?
Right now.
Right now, it looks like by December, they will be higher than last December. They're already higher than last December.
Yeah, home prices compared to June right now, June 2023 to December 2023, 6 months from now.
December 2023, Man, I'd have to look at the seasonal adjustment factors, but
Oh,
no,
come
not
on, just
much.
give an answer.
Higher, but not much. Yeah,
Okay, all right. And then you
higher, but
had
not by much.
okay, and then last month you had a forecast that the 30-year fixed interest rate would fall to 5.5 by the end of this year, 2023. Does that still seem likely?
Less likely
Yeah,
than I thought a
less
month
likely.
ago, right? Yeah,
Okay,
but I'm holding out with Anders that we
okay.
get under the 6 handle.
Yes, okay, I understand. And then when I asked, was it going to be the Lakers or the Denver Nuggets, you said there's a game, which was the wrong answer. And then Boston Celtics or Miami Heat, you picked the Boston. You're so that was
Yeah.
also incorrect last month, but it was good fun.
So
Hey,
Basketball Jones is not my middle name.
Basketball Jones, I remember that song. Um, Paul, it is always such a pleasure. Really appreciate you taking the time to share all your wisdom with us. I really, really enjoy it. If you're watching this video, please give us a thumbs up down below, subscribe to the channel, and a big thank you to Anders and Guaranteed Rate Mortgage for sharing that information. For everyone else out there, be well, and we'll see you next time. Aloha.
Aloha.